This trading setup is only for the New York equity trading session from 9:30 a.m. until 4 p.m. The markets in which you can use it are the S&P 500, the Dow Jones, and the Nasdaq. The model is not used on days with high impact news drivers like CPI, FOMC, NFP, and so on. The model can still work, but the probability on these days is way lower. First, we need to mark what is called the defining range, or short DR. This defining range is from 9:30 a.m. until 10:30 New York local time. Let us draw a box around that 12 candles in the 5-minute chart. Now I am going to mark the high and the low of this range, including the wicks. And here it is getting interesting with the first part of the rule. At 10:30 New York time, we already know with 88% probability the high of the day or the low of the day. I say it again. 10:30 in the morning, we already know with 88% probability the high of the day, or if price is closing, at least in a 5-minute time frame, above the DR, it is confirmed with 88% probability that the low of the DR is the low of the day, and vice versa. If price is closing below the DR, it is confirmed with 88% probability that the high of the DR is the high of the day. I will show you the implied defining range, or short IDR. For that, we draw another box and mark the highest body and the lowest body in the DR. And voila, we have our IDR. So the implied defining range gives you an early indication about what the high or low of the day will be. If price is closing above the IDR, you will have an early indication that the low of the DR is the low of the day. Note, when I'm talking about closing, I mean really closing above, not just wicks. And vice versa, if price is closing below the IDR, you will have an early indication that the high of the DR is the high of the day. Advanced tip number 1. Once the DR is finished, look at the open price at 9:30 and compare it with the close price at 10:30. If there is a reasonable incline, you should be changing your bias slightly towards the long side, and of course vice versa if you see a decline. If there's not a noticeable difference, you should stick with the neutral bias or the bias you already had before the opening. In this example, we are having an almost 20 points difference, which signals us that we can look for a long entry. When I say slightly more to the long side, I mean a 60% long and 40% short bias. So you are leaning a bit more towards long entries, but short is still on the menu. Advanced tip number 2. We are taking a Fibonacci retracement from the IDR low to the IDR high with 0.5 step standard deviation to the upside and downside to create a target projection for the trading session. As you can already see, these projections are quite accurate and will help you to define entry points and exits. Here you can see my settings for the IDR projections. Advanced tip number 3. As soon the DR is finished, the IDR levels become super important for the trading session. If you spend some time watching price action with this model, you will see how the algo is playing around these levels. If you see a reaction at these levels into the direction of your bias, it's almost every time worth considering a trade entry. Let's say you would have a long bias for this day. The thought process would be the following. After reaching the low IDR, the algo showed clear signs of rising prices. Now you can reverse engineer. If the price action would close below the low IDR, then the conclusion would be that the DR high is the high of the day with 88% probability, and your long bias would be wrong. As your bias is long, it is more likely that the low DR is the low of the day, so you could directly enter after reaction at the low IDR with stop 2 ticks below the low DR. In this example, we already have a long bias because of the open and close difference I explained before. Together with the rejection from the low IDR, I would enter a long trade with stop 2 ticks below the low DR. Number 4. This is about finding high probability targets for your trades without using any other model for it. Once price action goes above one side of the DR, it reaches the 0.5 standard deviation with extremely high probability, which gives you a low-hanging target for your profit taking. Tip number 5. Just because the rule is confirmed, it doesn't mean that you can't short anymore. If the price extended quite a bit into one direction, took buy-side liquidity and reached a PD array, you could potentially short a retracement. Just keep in mind that with an 88% probability, the market will retrace only into an internal sell-side liquidity or a fair value gap. So mind your targets if you want to short in such a scenario. Advanced tip number 6. After confirmation of the rule in one direction, the IDR high, the IDR low, and the midpoint of the IDR become highly valuable points after retracements to look for entries into the confirmed direction again. If these levels are matching up with fair value gaps, discount and/or internal sell-side liquidity, the already high probability becomes even higher. Note how the 61.8 retracement from the previous up move is syncing up with the high IDR. Number 7. Even after the close of the regular session in New York at 4 PM, the rule and the probabilities explained in my first video continue to be valid for the overnight session. That means, for the overnight session, we can expect with 88% probability that there will be no close below the DR low. We can also anticipate that price action is more likely to expand to the upside. That there is another DR in the overnight session. This DR is from 3 AM until 4 AM New York time, and it's called ODR and OIDR. The overnight DR is used to set the parameters of the algo for the European trading session until the opening of the pre-market in New York at 8:30 AM. Most of the time, the ODR is aligned with what we have already seen in the regular DR. In between the regular DR from 9:30 to 10:30 AM and the overnight DR from 3 to 4 AM in the morning, we will add the after session DR from 7:30 to 8:30 PM New York local time. So the ADR or after session DR forms from 7:30 until 8:30 PM and stays valid until 2 AM. As usual, all timings related to DR and IDR are New York local time. With valid, I refer to the rule set which is connected to every DR during the day. So from now on, we are only talking about ADR, after session DR, ODR, overnight DR, and RDR, regular DR. Also in terms of DR intraday cycles, the day starts with the ADR, followed by the ODR, and finishes with the RDR. We start with the upside expansion model. As you can see, each DR session respected the previous DR high levels and created higher low DR levels and higher high DR levels. Also, price respected, at any given point during the day, the previous formed low DR levels and did not close below them. The second example I have for you is the so-called range expansion model. Each single DR extended the previous range of high and low DR levels, while the midpoint stayed within the IDR levels of the previous session. If the midpoint of the DR levels goes lower, it means we will see a range expansion with a slight downward trend and vice versa. Usually, price close to the mean of the total range or close to it. Downside expansion model. It follows the same logic as the upside expansion model, just to the downside.